So as we look ahead to 2023, there's several key questions that need to be answered this year, as they're all going to have a significant impact on financial markets. So here are the 5 questions that I believe will be critical to watch. Number 1, where will expectations for the 2023 S&P 500 earnings ultimately land? So over the past year, the earnings estimates for the S&P 500 have fallen from about 245 bucks a share to around 220. This drop has a lot of implications for the valuation of stocks, as lower earnings estimates lead to lower fair value for the S&P 500. And by the end of January, we should have a lot clearer picture on the consensus for the expectations for the S&P 500 earnings, which is going to influence the direction of the stocks at the start of the year. But we got to remember that markets are always forward-looking, so at that point, they're already going to be pricing in the expectations for 2024. Number 2, when will global bond yields peak? So global bond yields, including those for the U.S. Treasuries, they've been on the rise due to a variety of factors, such as the Trussonomics crisis in the UK, the European Central Bank's hawkish stance, and also the Bank of Japan's increasing of the trading ban on their 10-year government bonds. But for global stocks to recover, it's going to be crucial that global bonds and their yields reach a peak. That said, it might be challenging if the German bond yields and the Japanese government bonds and their yields continue to rise. Number 3, when will core CPI drop below 5% year over year? The Federal Reserve is focusing on controlling services inflation. That makes up a big chunk of the core CPI number. And in the December CPI report, that core CPI metric was 6% year over year. So the Fed's going to be closely watching that indicator to determine when and if to pivot on any of these inflation control measures, with the goal really being to bring down CPI below 5% year over year. Number 4, when will the unemployment rate rise above 4%? So the Federal Reserve wants to see the labor market come into better balance, or to quite literally have more unemployed people before it can be more confident that all the things they're doing to drop inflation is working. So an increase in the unemployment rate, which is currently at 3.5% back in December, could be the indication that the Fed needs that their interest rate hikes are helping to start to restore balance to the labor market. So if the unemployment rate rises above 4% early this year, could be the signal Fed's efforts are paying off. Number 5, when will the 10s and 2s bottom and reverse? So the movement of the Treasury yield curve, and specifically the 10-year and the 2-year Treasuries and their spread, or the difference in their yields, it's a metric that can provide insight into when the bond market believes that the Federal Reserve will pivot on its monetary policy. So if the 10s and 2s spread bottoms out and it starts to rise and gets tighter, right now it's actually inverted, meaning that you're getting paid to lock up your money, getting paid more for locking up your money for 2 years than if you locked it up for 10 years, which is crazy to think about. When that happens, it could indicate that the bond market's now forecasting slowing economic growth and, or decreasing inflation, which would lead to a decline in the 2-year yield and an increase in the 10-year yield. That reversal of that 2-10 spread could also be a sign that the Fed pivot on monetary policy is finally on the horizon here. So all in all, the bottom line is this. Each of these 5 questions are important in their own respective way, because they're important metrics to keep an eye on this year as we get going. So I hope this video at least gives you some insight into the things that will dictate the Federal Reserve's policy this year, give you certain things to root for when you turn on the news, and subsequently the stock market returns this year. So as always, stay on point and take care.